Hello and welcome to this weekly Outlook video at xm.com. I'm Maria Bashardadis, and joining me is Senior Investment Analyst Rafi Boyajan. We'll be taking a look at the week ahead. So Rafi, let's begin with the US and China. On Wednesday, the two countries are set to sign the Phase 1 trade deal. But is there a chance that disappointing economic indicators out of China may cast a shadow over this interim agreement?
Well, there's certainly a risk that the Chinese data next week may disappoint. It is going to be an important week for Chinese indicators. We will have GDP estimates for the fourth quarter, as well as trade and industrial output and retail sales numbers as well for December. But of course, the current risk-on sentiment on the back of that Phase 1 deal being announced is still running pretty strong. It's probably going to take a lot more than some disappointing data to dent that positive market mood. That's not to say that we won't get any knee-jerk reaction should we see any unexpected weakness in the Chinese data, especially in the GDP numbers for the fourth quarter. We had seen Chinese growth slow to a three-decade low in the third quarter. Growth is expected to have held at 6% in the fourth quarter, but any misses there, especially a symbolic drop below 6%, might trigger some volatility in the markets.
Okay, moving on to the Eurozone, it will be a muted week. Only the German GDP estimate for 2019 may stir the markets. What should we look out for there?
So the German data will be the main highlight, as you say, from the Eurozone. Now, we have seen some signs that the Eurozone and German economy have started to stabilize. So the GDP numbers for Germany will be watched as the investors will want to get a sense of how the German economy performed towards the end of last year. So any unexpected weakness there would probably heighten recession fears for Germany. And now that we've moved on to 2020, of course, Germany is the Eurozone as well, not just Germany, is under the threat of possible US tariffs. And now that we've seen some resolution in the US-China conflict, the US might decide to move its focus onto the European Union because, of course, the US runs a large deficit with Europe as well. So, of course, a combination of negative data and trade tensions, of course, would be very negative for the euro. For now, though, the consensus view is that the European economy does appear to be stabilizing.
I see. Looking at the UK now, a flurry of data will flood markets on Monday and continue on through the week. What should we expect there?
Well, it's going to be an important week for the UK, especially after this week's remarks by Bank of England Governor Mark Carney, where he hinted that the bank won't hesitate to cut interest rates should the weakness in the UK economy persist. And there's going to be plenty of data to sift through next week, starting with GDP numbers for November on Monday. Now, we know that the UK economy was struggling prior to the December general election, so any negative surprises there probably won't be too unexpected. So the focus will probably fall onto the retail sales numbers at the end of the week on Friday, because in November we had seen unexpected weakness in retail sales. So if we don't get a rebound in December, then that's not going to bode well for UK growth moving into 2020, and that might push up rate cut expectations by the Bank of England, which of course would be negative for sterling.
And finally, turning to the US, we'll get inflation and retail sales data next week. Is this data likely to extend the dollar's rebound?
So we have seen impressive rebound by the US dollar following its end-of-year slide. And the US data, although it hasn't been too fantastic, it does appear that the US economy is still outperforming much of its major peers. And so next week's data will probably confirm that picture. We were expecting inflation to have ticked slightly higher in December and retail sales growth to have accelerated in December as well. So all of that should be supportive of the US dollar, but of course it depends whether or not there's a possibility of perhaps further spikes in geopolitical tensions, and that would have a mixed impact on the US dollar. It would be because it would push up safe havens such as the yen, but on the other hand we would see other currencies such as the euro falling against the US dollar.
Rafi, thanks so much for joining
Thank
me.
you.
And thanks for watching at xm.com.